Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we got another Simply Wall Street Journal for you people, and I'm going to be talking about return on investment, which, you know what, it's the reason why we're all here, right? It's the reason why we're all trying to invest, is to make a return and obviously to do well. So I'm going to talk about beating the market. And I don't know about you, but I'm not trying to be broke. So if you're not trying to be broke, smash that like button. Please get in the comments. Please subscribe to the channel. I'm on a mission to get to 2,500 subscribers. So with your help, we can get the world of investing out to more people and make it clear, simple, and transparent for everybody. But first, let's talk about beating the market. And today I'm going to give myself a little bit of a pat on the back, and you guys need to give yourselves a pat on the back whenever you guys do this as well. According to Simply Wall Street, the average yield in the market at the moment is 5.88%. Oh, MasterCard crosses. Who cares? Anyway, the average yield is 5.88%. My current total return at the moment is 6.2%. That comprises of a 3.8% capital gain, a 2.2% dividend income, a small currency gain for those US stocks, and a total return of 6.2%. Now, you would have seen, and if you go and check back, I think even just 2 or 3 Simply Wall Street journals ago, you would see that my return is like 2%. So obviously it just shows that in a couple of weeks things can change. I'm not going to count my chickens before they hatch, but obviously it's a good sign, it's a good trajectory, and I think there's a lot of contributing factors which I'm going to illustrate to you now of why my portfolio is doing much better than it was before. Could it still be better? Absolutely. I made some absolutely crucial mistakes which I've learned from, and I think my portfolio would be in a much, much stronger place than it was had I not made those mistakes. So I'm going to be very, very clear and transparent of what I'm going to do differently next year. I'm also going to review my goals. So I had an original goal that I set out to do when I very first started investing. It might have been somewhat naive. I'm going to sort of revise that a little bit. So stay tuned for all of that information today. But yes, as you can see, currently beating the market 6.2%, and the average yield is 5.88%. And I started to see that trend over the last couple of weeks, and some of the amazing contributing factors I'm going to pick out for you. The first one I'm going to pick out for you is Barrett Developments. Barrett Developments, as you can see, 26.29%, has been a fantastic holding for myself. Barrett has continued to, surpass their targets, not just meet their expectations, but also surpass their targets, surpass their sales, their order books, their revenues, their new home production. All of their targets they seem to be surpassing. I mentioned to you before, I lived in a Barrett home. It was a pretty good quality home, and you know what, I actually believe in the organization from a fundamental standpoint. When we take a quick look at Barrett Developments, you can find that it's a very, very healthy company, pays a good dividend, it's great value. At the moment, you can just take a look at this graph, and I started investing around this point, so you can obviously see the benefit. The difference is, this from 4.34 to about 6.54 is probably what, 60% increase. I'm only at 20% because I dollar cost average, so that means I've invested here, then 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 here, that reverb. And obviously that means I'm buying at high prices, I'm buying at low prices, so it kind of averages out. The reason why I took that approach was just to manage risk, because it's the first time doing this long-term investment strategy. I didn't want to go gun-ho, put a lot of money in straight at the beginning, and it could have gone from here down to here somewhere, and I'll be crying. So obviously I took a more risk conscious, risk averse approach. It's still paying me a fantastic return. It would be a lot more. I consider this maybe a slight mistake, but it's definitely a learning going forward. But as you can see, it's still a little bit undervalued, and I'm still happy. And even if the value does go, obviously no debt. I like companies that don't really have debt personally. That's just my personal thing, and the annual dividend is fantastic. So thank you, Barrett, for giving me a roof many years ago, and thank you for giving me a 20% or 26% return right now. The next one that's done pretty decent is Sentiment. Now, The reason why sentiment has been doing good, as I mentioned in my portfolio updates, it's a halo effect from the whole problems with the Fed and the whole China situation as well. So because there was so much turmoil in the equities market, people were moving their money into gold, and because they were hedging into gold, sentiment as a gold miner was benefiting from that investment, so to speak. So as you can see, I started investing probably around here, around this mark here. Yeah, December. Yeah, about this mark is when I started investing into sentiment, and it was doing well. And I was thinking, yo, sentiment, you're doing your thing, mate. I'm liking you. And then you just decided to disrespect me and drop and tank to this level. And what did I do? I added a bit more money. I bought on the dips. I overfunded because I felt that, you know what, in the long term it is going to come back up. And it hasn't reached those heights that it was before at around the £1.34 mark, but it has gone up to £1.18, which I think is just above what I started investing it as. But obviously, because I bought at so much more at this price, then obviously I've benefited from those dips. So guys, look, just take a look at this graph, right? This graph is what, about a year long, couple years, whatever. Like, every investment is going to go down, up, down, up, down, up, down, up. I've never seen a graph that only goes up. There's no such thing. So when you're getting into the stock market game, do not be concerned when you see the stocks go down. Don't be worried. Don't be worried about the intraday movements, intra-week movements. Let it go down for a month. Let it go down for 2 months. It could go down for 6 months. It doesn't matter. If you've picked a good stock, that time when it's down, when it's nestling at the bottom, and as you can see, it was at the bottom nestling here for a good 3-4 months. So from February to June, it was nestling at a level lower than I bought it at. So obviously I could be panicking, I could panic sell, I could take a loss, I could try and find. That all is not how to invest. That is not a strategic way to invest. So all I did is sit tight, you hold, you be patient, you know, you grab, I don't know, whatever it is, what's your drink? I don't know, like my drink is super malt. You grab a super malt, you know, you make sure it's cold, you just chill, you watch some Love Island, and you wait it out. You wait until the stock decides to return to the levels that it should be returning to. And if you've got extra capital, you then overinvest and you overfund and you buy at those dips. And obviously it's increased. When you look at the value, it's still undervalued for me personally. The future performance is still looking great. Again, another debt-free company. You know, I just don't like companies that are, you know, got debt. It's just, it is what it is. And then the dividend is modest. It's okay. 3.8% is decent. Expected to be 5.15 next year. It obviously hasn't, you know, had it for 10 years and 5 years and the dividend cover, etc. But I still think sentiment was a good investment. And so far, it's been so good. And there's a very, very high chance it could drop again. It could drop again. But I'm not going to panic. I'm going to repeat the same behavior, and obviously, you know, we'll take it from there. The next great one is Taylor Wimpey. Taylor Wimpey has been phenomenal. You know, I've done a video on Taylor Wimpey's special dividend. I originally bought Taylor Wimpey here again in December. It was about the 18th of December. So I bought originally at £1.33, and then obviously I've been dollar cost averaging. So buying at higher points, then lower points, and higher points, then lower points, and higher points, and lower points, lower points, lower points, etc. But because of their strong dividend as well, that has helped my return to be so well. So if you look at the Taylor Wimpey dividend, you can see it's 10.55%. So obviously, Taylor Wimpey hasn't been, from a capital gain standpoint, great the whole way through, but the dividend has been so strong that it's helped offset that. And as you can see, obviously, my total return at the moment for Taylor Wimpey is currently 16.86%. So those are some of the few, you know, great investments that I believe I've made over the past 7, 8, 9 months, etc. That's done really, really well. But as you can see, some of the recent surges, Snapchat is currently at 15.98%. I did make a video that Snapchat was a stock to watch. I was meant to invest into it about 4 months ago. I chose not to, against my own judgment. And guys, you guys need to trust yourself, and this is a journey for myself as well. Sometimes I research something, I research the hell out of it, and then I might wake up and think, you know what, I'm not going to take the risk with it for whatever reason. And you know what, it's your money. You deserve to not take the risk with your own money, right? It's your money. But then if you trust your judgment and if you've got a methodology, sometimes you have to back yourself. And that's the whole point. I doubted myself. I didn't invest in Snapchat. I lost 45% as an opportunity cost by not investing in Snapchat. I made a video on that so you guys can see, there was an original video when I said to invest in Snapchat. I didn't do it. 3 months later, 45% higher, I didn't do it. I decided to do it then, and now I'm 15% up. So cumulatively, I probably would have been about 60% up on Snapchat. If you actually look at the data on Snapchat, if you invested at the beginning of the year, I think you'd be 245% up on Snapchat. So you know what? Sometimes you just got to back yourself and back, your thoughts. Legal in general has been an awesome stock from a dividend and growth standpoint. The reason why the percentage doesn't look as high is just because of the dollar cost averaging. Same with Aviva. First Solar has been probably, I would say, arguably my top 3 purchases. Again, I've just updated a lot more money into First Solar now. Just that's the reason why the percentage has obviously dropped. The reason why I've done that is just because I think it's still going to continue to grow. So I wanted to take the opportunity to get some more money in at that point. So yeah, between Taylor Wimpey, First Solar, the insurance stocks, Centamin, Barrett, I believe there's been some really, really good performers. Now, obviously, there's been some not so good performers, one of them being Vodafone. Now, I always mention that Vodafone, I'm expecting to pay back after a couple of good earnings reports and by the end of the year because of 5G. Now, one of the key things that happened after I invested in Vodafone is they announced that they're cutting their dividend. And to me, it wasn't really a big deal. They're cutting their dividend by, I think it was 40% or 10% or something like that. I can't remember what the actual figure was. And they did that in order to reinvest in 5G. And when you actually look at that in terms of monetary terms, it's like, I don't know, for every, let's say £50 dividend you would have get £44 or something like that. Like, I'm giving you arbitrary figures, but the way I worked it out is that it wasn't that significant. It just sounded a lot higher than it actually was. And so, because of that, the market reacted to it, and obviously the Vodafone share price actually started to tank and not do so well. So you'll be able to see that in the graph here, where it just started to I think it was this period here where it just kind of dropped and it's trying to sort of recover a little bit. The Vodafone for the last year or two has been, steadily tanking, but I still think it's an undervalued stock. I think their future performance is going to be strong. I'm basing it on the fundamentals. I'm not basing it on the market. Yes, they have a little bit more debt than I would like, but they do pay a strong dividend as well. And so, you know what, I'm going to consistently back Vodafone, and what I'm going to do is, try and fund more and, try and take this as, an opportunity rather than something to be overly concerned about. Another sketchy investment was Imperial Brands. Where are you? Right there, minus 2.62. Now, Imperial Brands has been a funny one because Imperial Brands, as you will see from this graph, has been horrific, right? Look at I invested somewhere around here, and then, it started to, and then it went, and gone. So, the story with Imperial Brands is that it was rising. I was dollar cost averaging it rising, thinking that, it's doing well, adding more money. And then obviously the risk with dollar cost averaging, is that when it goes up, you're buying at a higher price. And then if it starts to tank, that happens. And so I was like 25%. And obviously because the share price for Imperial Brands is so high, being around 21, 22 pounds or whatever it was at the time, you got to remember, if I'm buying 100, 150 pounds worth of shares at a time, the amount that 25% loss is greater than, say, a 25% loss in another stock in terms of the actual volume. Now, recently, they announced a share buyback, and that share buyback has seen the price increase. But what I did before the share buyback was announced, so I didn't realize the share buyback was actually happening, or maybe I did it after, but I didn't actually know about the share buyback at the time, is that I doubled down. Now, I don't recommend doubling down. I think it's quite risky. I kind of took that approach from my day trading days. So when you day trade, there's a concept called averaging down. And let's say, for example, you put £100 into a stock. We're going to just say Apple, although you can't. Let's say you put £1,000 into Apple when you're day trading, and then it drops sort of 5%. What some day traders do, rather than basically lose £50 or whatever, what they'll do is then they'll follow it with another £1,000, or they'll follow it with £2,000 because it's gone 5%, because they then expect that if it goes up by 2% from the new lower level, then they'll break even, and if it goes up by 3%, then they'll actually get a bit of a return. So it is a risky strategy, because if you carry on like throwing money at it when it's falling down, then potentially it can continue to still fall down anyway. And so you're just throwing good money after bad, is what some people do. Whereas other people will say, you know what, if it's always going to go up and down through the course of the day. So if it's going down, just throw more money at it. Make sure you leave some money in your account, throw some more money at it, and when it does rise, you'll probably break even. So I used to take that approach a lot to, minimize any losses and try and maximize gains in my day trading days. And so I decided, you know what, I'm going to kind of do that approach with Imperial Brands. I had, I think, can't remember how many shares, but however many shares I had, I doubled it, or added at least another 75% or something onto it. So between that and the share buyback, it means that now, where I was 25% in the red, I'm now only 2.62 or whatever it said in the red as well. So that's an approach I took. In the videos, I've always talked about having an emergency fund. The reason why I have an emergency fund in cash sitting there is in order to do things like this. I do not believe in investing and then having, the cash savings is money that you can't touch. You need to have the money that you can't touch, because you're saving for a house, or you're saving for something that you need to obviously pay cash for. Sometimes you can't pay for things with Snapchat shares. Do you know what I mean? You need to have some cash in the world. So put that money to one side, but then you need to have an emergency fund that when you're investing into the stock market, you can obviously take advantage of this in order to minimize any particular losses. And then obviously very recently I've been putting money into ETFs, which obviously some of them haven't done so well so far, but as I mentioned, most of my ETFs, if not all of them, are 25-30 year horizons. I'm not looking at ETFs for a flip. I'm not looking at ETFs for a gain in the short term. Now if you look at my pie is looking very green right now, which I'm really happy with. And obviously I want it to obviously get a lot more greener, a lot more sooner, and a lot more longer, further, and any more adjectives that I can currently think of at this current minute. So the two that I mentioned that you can see in orange, Vodafone and Imperial Brands. You've got something here which is Lloyd's. Oh yeah, I need to get rid of Lloyd's, but it's just, yeah, whatever, we're not going to talk about Lloyd's. And then it's like another one here somewhere, Trig, but nah, Trig, you can stay, you're good. Yeah, and so all I'm gonna sort of recommend to you guys is, definitely always have periodic reviews on your portfolio. See where you are versus the market. See what you're doing so well, what you made some good decisions on, what you made some not so good decisions on, and then what your strategy, what your gameplay is in order to counteract those decisions. Are you going to add some more money like I've done with Imperial Brands? Are you going to close those investments? What you can't see here is that I closed Weibo, I closed Man Group. Did I close another one? There were investments that I closed. I closed them. I got rid of them. Get out of it. Like if I feel that after a while, you're not gonna stay within my portfolio, it doesn't fit with what I'm trying to do or what I'm trying to achieve, then you got to go, man. You got to go. So sometimes you have to close investments. Sometimes you have to keep them and add more money. Sometimes you just have to hold. But you have to take each one on its own merits and work it out that way. So yeah. This is all about beating the market. I really wanted to create, a positive video and just to encourage you guys that, take this seriously. Try and work out for each of your individual stocks what it is that you need to do in order to try and beat the market, in order to try and do well. Had I just put all of the money in an ETF, I would not be beating the market right now. So, I am an active investor. I want to try and get the maximum gain I possibly can get. In terms of my goals originally, I think I came up with a goal of trying to get 50% return in 3 years, which is about 15% a year cumulatively or something like that. I think that was a bit of a stretch target, considering the fact that now I'm sitting at 6.2%. And you know what? I might be doing a video in 2 months eating humble pie and being back at 1% again, or worse, being in negative. You just don't know what's going to happen with the economy. But I thought I'm going to just take this time while it's in positive. So at the end of the day, I think from that standpoint, set realistic goals that you believe you can achieve. And so I'm now revising my goals for more of a 3 to 5 year period. Um, but I will have a 3 year milestone goal that I'm still trying to achieve. I don't know if it's going to be 50% in 3 years. It might be a bit less. However, it might be a bit more because now there are certain things I'm going to do differently. One of the things that I will do differently going forward into next year, and I'm starting to actually now think about next year and think about forward planning. In my mind, we're in August. There's about 5 months left of this year. And so I'm now thinking about how am I going to best invest for 2020. And currently, my train of thought is that I'm only going to dollar cost average when it comes to, value and dividend stocks. But with certain growth stocks like the Snapchats, like the First Solars, those ones that, can perform really, really well, I'll just put a lump sum in up front. And leave them, and then maybe if it dips, put another lump sum in. I might only invest in them twice on a yearly basis rather than dollar cost average them, because dollar cost averaging First Solar didn't do me any justice whatsoever, considering how good it's performed. It's only ever gone up. Like, I can show you the graph right now. Why don't I show you the graph right now? Let me just show you the graph right now. It's only ever really gone up since I started investing. There you go. So I started investing in First Solar maybe around here, I think it was, because that's probably around Feb sometime. And as you can see, just gone up. So dollar cost averaging in this instance, um, in some ways it's okay because it's rising, but in other ways it's bad because you're just continually buying at higher prices. I'm never buying at lower prices in order to make more money with First Solar. So in this scenario where I've got a growth stock that doesn't pay a dividend, and isn't undervalued, what I'm going to do, well, it's still undervalued, but it doesn't pay a dividend. What I'm going to do is just put a whole bunch of money in at a period like this and just hope that it continues to rise, and then obviously deal with it that. So I am going to try and reinvent my strategy for next year, and obviously as time goes on, I will keep you guys updated with what I plan to do, and you guys can obviously have a think about what you guys are going to do. But yeah, I just wanted to cover off beating the market, reviewing your strategy, reviewing the top performers and the worst performers, and obviously what you're going to do with that. And I hope you guys found this information useful. So if you did, please like the video, please comment, please subscribe to the channel, and I will catch you next time with another investment video. It tells me I'm primarily an income portfolio with some value. They're chatting rubbish. Anyway, have a good day. Happy investing. Peace out, guys.